Welcome to Theo Trade. This is Don Kaufman. March 23rd, 2020. About 4 minutes to go to the cash close. The S&Ps are on a tear right now, back to the upside. It has been a chopped out, volatile trading session once again. But today, we've actually got a split marketplace, and that is the S&Ps are down by about 52 handles, the NASDAQ up 52 handles, the Dow still getting hammered upon, down 400, and the Russell still off by the tune of about 1%. What we intend to do on this evening's video is really highlight some of the opportunities and some of the areas that have just been outright slaughtered in this marketplace. And we're going to look sector by sector to really how much damage has kind of been inflicted upon this marketplace, because you'll see some surprising areas actually when you start looking sector by sector. And I think you actually may start to find, if you will, a couple of opportunities. With that, though, we're also going to show the possibility of considerably more risk in a few areas as well. To do this, again, the S&Ps are off by the tune of 2%, which, quite frankly, let's say, hey, it almost feels like an up day, which is sad to say that because we've just had back-to-back 4 and 5% down days inside of the marketplace. As I said, one thing that stands in very stark contrast to some of the previous trading sessions is there are some positive areas. This is not, just abject, hideous marketplace. There are a couple of underlyings that are positive. This is not, full-blown correlation per se to the downside. It's kind of often what I call like a full court press. Full court press is when you're looking at this and this is 95 to even 100 products to the downside. There are, again, some positive stories in here, but most of those are just that. They've actually got news on them, which is actually popping a couple of underlyings to the upside, specifically Boeing. The irony is Boeing's doing quite well today, which is, of course, a component of the Dow. Nevertheless, the Dow is still off quite considerably by right now 450 points. Now, how can that possibly be? Well, we're going to key into a couple of those underlyings, including, of course, Apple. Let's get down to it. Let's start to actually break down sector by sector. For that, what I'm going to do is I'm going to revert back to a style that I haven't used in quite some time. And that's simply because we've just been in some wild volatility, right? We're real focused on the S&Ps and so forth, but it's time, again, take a little bit of a breather, step back from looking, at the screen in just awe. Let's start to look at these sectors. Well, to compare sectors, first of all, I'm going to use ETF products. And the primary product that I'm going to use, is going to be none other than the spiders. So when I say a primary product, well, we're going to compare the spiders versus, again, a grouping of ETFs. Which ETFs? Well, let's get down to it. There's a previously used style here. I come down to load style, cruise up to, and again, I have what we call a sector comparison chart. So what the sector comparison does, it's just a 1 year. So I'm looking kind of year over year, and I'm just going to leave the mouse there for a second so you can see on this comparison chart, we have XLU, which is utilities, right? Then we have what? We can kind of go down the list, use XLF and XLK and XLE and XLP and XLV, XLY, and then XRT. So for the most part, let me actually zoom in and take you this. Now, again, this is year over year. If you wanted to be, a little bit more just about it, you could say, all right, hey, you know what, Don, just take me into the last 3 months. And we're going to do that here momentarily. But initially, I like to get a bit of a broader view of, first of all, what is currently going on, but more importantly, where we've kind of come from, to give you an idea of really, how hideous some of these sectors happen to specifically be. Start from the bottom up. This will be no surprise to anybody. This is the energy sector. This is the XLE. Again, the XLE, which is effectively down just about 64% in the last year. Second to the bottom over here is none other than the XRT. Now, for those of you that have tuned into Theo Trade for a while, I've been short quite considerably inside of the XRT. Retail, we anticipated to get hammered. There's the closing bell. S&Ps, they staged a rally and gave it up into the cash close. People, that was ugly. I mean, we just lost 25, 26 handles in a matter of a few seconds here into the cash close. Back over here to the comparison, though. And again, I want to try to stay focused on this. Hey, listen, I'm still a trader and I still stand here and I'm looking at this and people, again, it's ugly. There is real damage being inflicted in this marketplace. I mean, the energy sector, if you step back from the entire situation we're in with the coronavirus and you just pushed aside that the coronavirus, okay, ever even happened, you realize that, people are, oh, maybe we're in a recession. Are you kidding? Energy sector alone, okay, will decimate this economy. And that's one of the things that they constantly miss because, again, while you're watching the ball coming towards you, you're missing, okay, sometimes some of the bigger picture over here. And the energy sector alone speaks volumes on here, okay, just speaks volumes. And that is, again, and I'm clicking on the energy sector over here, the XLE, which when I say it speaks volumes, okay, this sector has been, again, for the most part, now we're 64%. That's alone enough to push the U.S. specifically into a recession. More importantly, into again, on a broader note, a global recession. So on top of it, again, of course, you've got retail. Now you're looking a little bit more at the coronavirus. So then on top of that, okay, what's the third sector from the bottom? That's the financials. There's no surprise there. And there's no surprise there simply because when the energy sector is getting hit, obviously, who's going to be carrying some of the bag of risk? It's going to the financials. But the financials have their risk compounded because for the most part, every sector is getting hit right now. And in the end, this could actually turn from a crisis very easily into a financial crisis. Now, you have to also kind of respect when I'm looking at this on a broader view, okay, and where we've kind of come from. Let's also remind one another for a second. The Fed came out today and they pulled what I would term a Mario Draghi. And for those of you that don't remember Mario Draghi, he was the head of the ECB, European Central Bank. And he had a very famous speech years ago. And when they asked him, basically, what are you going to do to support the European Union? Whatever it takes. I mean, it came down to whatever it takes. The Fed pulled today, or whatever it takes. So most of you are aware that it seems like forever ago, just a few weeks ago, the Fed actually lowered rates, and then we lowered them again to zero interest. Okay, now the Fed has officially kicked on quantitative easing. Okay, and for the first time in history, not only have they kicked on quantitative easing, but the Fed will now go out and they will buy corporate bonds in the United States. Corporate bonds in the United States, it's never been done here before, but of course that's one from Mario Draghi's book. On top of it, okay, the Fed is also going to open up a lending window into ultimately small business. So helping small businesses there, along with the Small Business Administration, the Fed is actually opening up the piggy bank on all fronts, and they're going to do whatever it takes. With that, the S&Ps are still down 3%, which brings me back over to the financials. What I'm a little nervous about at this point in time is the financials. Again, you talk about sectors and how much damage has been inflicted. The damage right now is inflicted, okay, almost expressly here inside of the financials. That's what would concern me inside of this marketplace. When they're off by 6%, you better pay attention. And when they're off by 6% day in and day out, okay, effectively over the last year, and I want to reiterate this, the financials are down approximately 30%. Now, when you start to zoom in, though, on tighter time frames, let's actually take it from 1 year, cruise all the way down to a 3-month time window. On a 3-month time window, this is where things start to get just hideous in terms of like outright carnage. Okay, when you start to see the products down close to 40%, again, just over 40%, I should say, on a 3-month basis. All right, let me actually knock that time frame back out to 1 year because we're not done here, and we're not done by a long shot in terms of the different sectors. So when I was saying this earlier, how much damage has been inflicted, clearly the financials, okay, have been damaged. Energy has been damaged. The retail has been damaged. So, of course, the question is going to be, where would I come in first? Okay. I think at this point, okay, that there is some nibbling that can go on inside of the energy sector. And that can be done by means, okay, of XLE. All right. So XLE, of course, is our energy sector ETF. But I would also, okay, not hesitate to necessarily look at XOP. And XOP has become $7.54. And this is oil and gas. Okay, this has got some higher risk, though, inside of the portfolio. So don't be surprised, again, to see this even get halved from here. It's possible, possible and plausible. But you can see I've already got positions in it. And you know what? I'm telling you right now, I know that I can't pick a bottom in here. But I do know, okay, over the years of experience, that you're going to have to go out there and nibble just a little bit. All right. I mean, we're looking at an ETF. Okay, an ETF, which has no CEO or CFO to get taken away in handcuffs, and it has 150% implied volatility 25 days from now. Like, that almost doesn't resonate. That's the kind of stuff that you saw back during the financial crisis where you're like, oh, I should have been somebody. I should have sold premium into that. Okay, but at this point, I got to tell you, it's still early in this crisis. You know, when I'm hearing about, entire cities being locked down specifically today, and the lockdown just started today, I'm going to tell you, it's very difficult for me to want to get a little bullish at a time like this, okay? I am not, and again, I want to reiterate this time and again, you're not going to see me run into a burning building right now, okay? And I'm going to show you specifically why I wouldn't run into the burning building. First of all, on top of the screen, XLK. What is it? Technology. Right below it, okay? XLP. Now, XLP is consumer staples. I've also been very critical of consumer staples as of late, because quite frankly, I don't think Walmart and Costco are going to hold it together in this. The initial onslaught is probably to some degree over. Yeah, well, do you have your toilet paper? Have you built your castle of toilet paper yet? Because it's probably over to some degree. Nevertheless, the rest kind of fall into the middle of the pack over here. But again, I want to show you areas, I would say, where damage has been inflicted, but it hasn't been enough. And I keep reiterating the same couple of stocks day in and day out. On a year-to-date percentage, I'm bothered by Microsoft. Okay, Microsoft, and I'm getting real stock specific, and I'm going to talk about both bullish and bearish, right? So on Microsoft, it's only down 15%. Okay, compared to what? Well, compared to the Qs. Okay, Qs are actually down some 21%. So Microsoft is outperforming the Nasdaq, but how much is it outperforming the spiders? Well, the spiders are down 31 on a year, 31% year to date. This is big. All right, because the opportunity, of course, is if Microsoft were to bounce, we would short it. We did short it. Okay, we've actually already pulled off the position and pulled it off profitably. So we put on an in-out spread, of course, last week. We discussed that on the bounce. We shorted it. We had about a 37% gain inside basically a trading day. We already pulled the position off. Now, where else do I look for some opportunity? I continue to kind of hunt Apple. Now, Apple is starting to show some signs. Now, listen very carefully on Apple. I'm not going to talk about building a trade per se on Apple just yet. Apple, here's my discontent and my larger area of concern. There's a lot of people that are going to need money. They're going to start dumping 401ks when portfolios start to go. Apple's the number one holding. Keep good eyes on it in the next couple of days. And I reiterated that from specifically last week. You keep eyes on Apple. Okay. Why am I so concerned about Apple? Because I saw some of this earlier today. If you actually look on an intraday basis, Apple was getting slaughtered. It came back up to some degree. Now, my concern, all right, goes beyond Apple. I also want to bring up XLU. XLU, what is it? It's the utility sector. Okay. This outright carnage. Utilities. I want to remind somebody, okay, and everybody, utilities are specifically supposed to be low risk. They're a low beta. In fact, if you took a look at their beta, it's probably about 0.25. Here it is, 0.24 beta. What that basically means, for every 1% move in the S&P 500, you're supposed to get about 0.25% movement inside of the XLU. So why is the XLU getting crushed almost to the rate? Remember, the spiders are down 31%. Okay, and again, XLU is down by the tune of about 29%. How could this possibly be? It's because this is actually retail portfolio. This is again, you would think that they would come screaming into the XLU. Why? It's 4.22% dividend. There's a yield on this thing, and it's a big yield. How come nobody wants to hold the XLU? Obviously, some energy concerns in there. Nevertheless, this has to do with retail portfolios and mutual fund redemptions. If you tell your mutual fund manager you want money back, that mutual fund manager has to go into the marketplace and whack that particular underlying. There's a ton, okay, of retail now in low beta stuff because they felt it was going to be lower risk. Ironically, the low beta stuff has become higher risk. If you don't believe that, go take also a look at XLP. XLP has also been sold to people as being a relatively low beta at 0.60. Okay, it too down about 22%. Now, these are supposed to be massively outperforming the norm here. Again, it does appear that we're starting to see, if you will, okay, some pretty heavy retail redemptions of mutual funds. And we'll start looking at inflows and outflows of different mutual funds because that stuff, it's transparent, but that's after the fact. Like by the time you actually figure out what the redemption level is of some of these mutual funds, it's already too late. I'm telling you right now, by looking at the XLU, by looking at Apple, by looking at XLP, again, it's consumer staples, okay? This is what people want to own. And what I mean want to own in terms of a stock, because it pays a pretty good dividend. XLU also fairly strong dividend. They're hitting stocks like Caterpillar. Again, these are widely owned products that are starting to forge into new low territory. Meanwhile, and this is what I said, Apple surprises me. That yes, it is down 25%, but it's still outperforming, okay, right now the S&P. There's one last thought that I really want to provide you on this particular front. Again, it's really important that sometimes you step back and you got to look at some of the carnage that's going on inside of the broader marketplace. But one last thing that I really want to point out on this front, because again, I kind of feel like everybody right now, they want to come rushing into the fire and they want to look for like, this is an opportunity. It's going to be the greatest opportunity. People, it's early. And, you know, you can look at volatility, you can look at all these different things, but there's a few things that really stand out to me. Okay, and one of those is using a comparison chart. This is actually a comparison that I've used in the past. It's the QQQ versus the IWM versus the spiders. Okay, and one of the things that's kind of shocking, and again, if you've experienced in trade, you'll know this, but the divergence between the major index products, the NASDAQ, the IWM, okay, the spiders, that divergence is huge. And again, I'll make it very, very clear what you're looking at on the screen over here. Right on the top, this happens to be the Qs. Okay, so I want to label them just so you guys kind of understand. That's the QQQ right there. Okay, this little monkey right here, that's the spiders. Okay, on the bottom of the pack, of course, is the IWM, the Russell. Look at that divergence. We're talking almost 20% simply on a year-to-date basis. What's unusual about that is during degrees, okay, of wild capitulation in a marketplace. Typically, it doesn't matter who you are, where you are, what index product you belong to. They hit them, and they hit them all. Hence my concern for something like Apple. Hence, I would be very concerned right now in the technology side of things. The NASDAQ, okay, strictly opinion from this point, it's on borrowed time right now. Okay, we're going to run out of fuel to sell into financials. We're going to run out of fuel to sell into energy, right? Then where are they going to go? They're going to rotate, and they're actually going to start realizing, hey, again, technology is not going to be immune to this sell side activity, especially when we start to see redemptions of major funds out there. Another day inflicting more damage upon this marketplace. Listen, we're well overdue for a bounce, but we just don't seem to be able to catch bid. Stay tuned. Thanks everybody for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.